So let's just take gold at fair value, and we could have bought 105 ounces of silver. Well, if we were to get back to, let's call it 100 ounces of simplicity, if we were to get back to 20 ounces of silver, that means the silver price has to be 5 times what it is now. So you can see how far silver has to go to get back to some sort of normality. Now, I don't think there's anybody who realistically expects we're going to get back all that way back in short order, but there's a lot of room for silver to move upwards in the near term, and it could move a long way. And I don't know where the end lies, but I think we're north of $40 is where it goes.
Silver is one of the main metals in the world of industry, with its market value estimated at approximately $1.8 trillion, according to companies' market cap. Just as silver prices are affected by the general economic situation, and the industrial situation in particular, it is also considered a safe haven during times of recession. Renowned expert Clive Thompson points out that silver is deeply undervalued, and return to its historic 17-to-1 ratio could mean a 5-fold silver increase. Thompson suggests silver could soon vault past $50 as surging demand collides with a tightening supply squeeze. Clive Thompson notes that silver supply is falling, while industrial demand, especially in electronics, is rising. However, he points out that if more investors begin to view silver as a strategic asset, not just an industrial metal, the price could rise dramatically. Overall, a 5th consecutive year of deficit in the silver market is likely to keep the prices higher. So any major fall is unlikely. That leaves the chances high for silver price to end the year higher for the 3rd consecutive year. Looking at fundamentals, Thompson highlights a widening gap between physical and paper silver markets. Since January, large players have been taking delivery of 5,000-ounce bars on COMEX. This shift is thinning the paper market and raising the risk of volatility. Approximately 1 billion ounces of silver trade in the paper market daily, while miners produce only about 830 million ounces annually. This disparity, 240 billion ounces traded annually versus 830 million ounces produced, reveals the extreme disconnect between paper markets and physical reality. The 350-to-1 leverage in paper markets creates potential for dramatic price movement when physical demand stresses the system. Regarding the mining sector, Thompson sees gold and silver miners as undervalued, predicting strong upside with many likely to show price-to-earning ratios below 10 next year. Before we dive into Clive Thompson's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the markets. Let's get into it.
At the moment, the supply of silver coming out of the silver mines is declining, and the demand for silver for industrial use, in particular the electronics industry, is rising. About 2 or 3 years ago, there was a crossover between the supply and demand such that we went into deficit silver. So the difference between the two is now being supplied, the shortage of silver is now being supplied by recycling. And if you want to continue to, that deficit in silver is going to continue to grow basically as far out as the eye can see at the moment, because the mined silver is not likely to go up according to the projections. It's been falling for many years and it's still likely to fall. So the difference has to be supplied from somewhere, and that surplus silver has to come out of recycling. And the only way you get people to recycle their silver is through the price mechanism. Put the price up and more people sell a bit of silver. There'll be traders, there'll be people who hold silver bars, there'll be people who sell silver ETFs. Price goes up, they'll sell a bit, and the thing gets back into balance. But what if we get to a situation where people start to see silver as an interesting investment? It could go a lot higher. And I think we've seen some possible signs of that in the last week or so. We saw the price break through $35, and I put out a post within seconds of it going through the $35 mark. And I basically said, silver's just broken through 35. That was a trigger point for many traders, and it could easily go to $36. And I just look at the screen now. Oh, good heavens, we're above $37 today. So it's moved fairly fast in the last few days, and I think that it's likely to go above $40 in the coming weeks. In fact, I'm just looking I did an AI search on silver this morning, and let me just read you what that said. If I can find it now, I'm just looking for it.
Sure.
I'm sorry about that. It was a 30-page article from AI on it, but it should be up here. Can't lay my hands on it. But the gist of the article was the present price performance indicates that it should be moving above 40 and perhaps on the way to 45 this year, and within not too much time, a $50 is possible. Of course, there are plenty of traders who are using the paper market, the COMEX, to trade silver, but we've seen in recent weeks unusual deliveries, or recent months, I'm talking about since the 1st of January this year, unusually high deliveries of both gold and silver, where people are, rather than rolling over their contracts, they're taking delivery of the 5,000 ounce bars. These are pretty heavy things and they're worth a ton of money. So it's not mom and pop taking delivery. So someone's taking delivery, and the more delivery which is taken, the less that paper market becomes liquid for those who want to sell short. Because if they're selling short, they're only selling short because they believe they can lay their hands on silver when it comes to deliver, or they've actually got it somewhere stored away. So I think that my feeling is that the paper market is getting thinner, and that might be a reason why the silver price is rising. Of course, I have no physical evidence of how big the shorts are. There's a lot of talk about it, but nobody's actually been able to pin it down. There's no statistic you go and look at and say, oh, someone out there's counted the shorts, because these shorts, they could be bullion banks, they could be hedge funds, they could be private investors, they could be governments trying to suppress the price. But none of these figures are published by anyone, and therefore you can't actually know, when you see the trading on COMEX or anywhere else, how much of it is naked shorts and how much of it's covered shorts. Historically, the ratio between gold and silver, we go back a long time ago, was something like 15, 20 times, I'll call it 17 times. 17 ounces of silver bought you an ounce of gold, or an ounce of gold bought you 17 ounces of silver. Now, very recently, a few weeks ago, ounce of gold would buy you 105 ounces of silver. What does that mean? It means either that silver is massively undervalued, or that gold is overvalued. And I take the view that gold is not overvalued. I think gold is undervalued given the growth in global debt. So I think gold undervalued. So let's just take gold at fair value, and we could have bought 105 ounces of silver. Well, if we were to get back to, let's call it 100 ounces of simplicity. If we were to get back to 20 ounces of silver, that means the silver price has to be 5 times what it is now. So you can see how far silver has to go to get back to some sort of normality. Now, I don't think there's anybody who realistically expects we're going to get back all that way back in short order, but there's a lot of room for silver to move upwards in the near term, and it could move a long way. And I don't know where the end lies, but I think we're north of $40 is where it goes. Well, first of all, I think that there are sectors which look particularly attractive. I think the mining sector across the board, but especially gold and silver, looks attractive. The reason for that is the price of gold and silver are both much higher than they were. The analyst forecasts were made some time ago, in each case at the time the company reported its last results. Analysts tend to not stick their neck out and leapfrog each other too much. If they do leapfrog, they leapfrog a little. So for most gold and silver mining companies, we don't have any new reports which were made around the current prices. If you factor in the current prices, and I've done this using artificial intelligence to do the maths. I can do it manually, of course, but it's much, much faster using AI. You'll find that many of these companies will, next year, based on prices which are much lower than today's, be on price earnings ratios below 10. So growth with a ratio of less than 10. That means they're going to be cheap, and they're going to be showing growth if the price stays where they are. So I don't think either if the price of gold and silver just holds where it is and doesn't go up at all, those gold and silver mining companies, in my opinion, will be looking much more attractive to investors next year than they look today.
Clive Thompson believes the fiat currency system is nearing collapse, with a sudden reset likely triggered by unexpected events. He views the BRICS push for a gold-backed currency as a real challenge to US dollar dominance. Central banks, especially in non-Western nations, are quietly accumulating gold as a hedge. With US debt rising faster than its economy, Thompson warns that trust in the dollar is eroding fast. The use of the US dollar in trade among BRICS countries has been leveraged to approximately one-third of its previous level. While the de-dollarization impact has optimized beyond economics as nations seek greater financial sovereignty and independence, many believe dollar hegemony is virtually untouchable thanks to largely unmatched US military, institutional, and cultural might. But gold prices are making clear that confidence in the US dollar is waning, and nations are preparing for a new paradigm. From a technical standpoint, Thompson mentions that banks are now reintroducing gold into their preferred asset classes, with some forecasting prices as high as $4,000. Even institutions that once dismissed gold are recommending small allocations as a hedge. Let's get back to the interview.
Absolutely, definitely witnessing the slow motion end of the fiat currency system. Now, for the last 2 or 3 years, I've been saying I think we're at 5 minutes to midnight when it comes to the fiat currency system. And people say, well, what are you talking about, Clive? I say, well, maybe 2027, maybe 2025, maybe 2030. But I think we're pretty close to the end. But I had a lot of people would then sort of laugh at me and say, you got it wrong, Clive. It's, the thing's going to carry on. They'll just inflate their way out of the problem and everything will be the same. But I've noticed a subtle change in what people are saying. They still say I've got it wrong. And they say it's not 5 minutes to midnight now. It's 2 minutes to midnight. So I think what has changed, we've been talking about this reset situation where global currencies have to reset. And basically, when you have a reset, it basically means a lot of people who've got the fiat exposure suddenly find they can't use it, can't deploy it because there's something different. There's a new type of system. What they had in cash or money in the bank or bonds isn't what they thought it was. It doesn't buy what because they now have to use something different. So, that is getting closer. And when it happens, there won't be much of a warning. It'll be one of those things which comes very, very fast in an unexpected situation. It could be a war starting. It could be a geopolitical situation. It could be an internal political situation. It could be civil war. It could be a natural disaster. It could be just a panic in the financial markets where the bond prices are plunging and the Federal Reserve and the Bank of England and the Bank of Japan doesn't provide the help they're supposed to. We don't know exactly how it could end, but we might suddenly wake up one day and find the banks are closed, just as happened in February 1933. There was no warning that the banks were going to close then, but of course, once they closed and reopened 2 weeks later, people then knew the writing was on the wall. And what followed was a month or two later, they then said, "Okay, everybody, you hand in your gold." And those who handed in their gold then found themselves gypped out of $15 an ounce when a year later, nearly, they raised the price from $20 to $35. So, everyone who handed their gold, it was rather disappointed, because if you still illegally held on to your gold, you could have taken it down to a jewelry shop who would have chucked the gold coin in with the bracelets and things and probably given you a bit more than $20 that was on the face of it. Obviously it wasn't completely illegal to do that, but people could have had a lot more just before that currency reset if they'd hung on to it. So what's happening? It's going to come, but we don't know when. It'll be an unexpected situation, and when you know it's coming, it will be too late to buy any gold or silver or anything. The dollar's dominance carries on, but it is a bit like a giant supertanker in the ocean. It's very hard to turn it around, but other nations are building their supertankers in their own way, and that's going to take. It's not going to happen overnight. It's going to take some years, and even when it happens, it still won't change the fact that oil and so forth is going to be quoted in dollars. They might say, we should quote it in renminbi, or perhaps the new gold-backed BRICS currency, or whatever they decide to bring in. What I think will happen over time is that at some point, and we're a long way from that, a new BRICS central bank will be formed. We'll call it the BRICS Central Bank. It might be headquartered in Switzerland, it might be headquartered somewhere else like Singapore, I don't know where. And that BRICS bank will probably hold a certain amount of gold deposited by each BRICS member. And in return, each BRICS member will receive a certain amount of a global BRICS currency. And that BRICS currency will potentially be convertible at the central bank back into gold. But the nations won't trade in gold, they'll trade between themselves in the BRICS currency. And if there's a trade imbalance, then unless it's corrected, potentially the nation which has got the surplus funds will be able to, in some way, shape or form, ask for that to be changed in gold if they wish to do so. And things will start to balance out again, just as they did while we were on the gold standard. Trade imbalances were sorted out in a certain way. Either a currency would devalue, but of course, if you've got your currency, if the currency is the BRICS currency, that's not going to be the currency of any one nation. And if it's convertible to gold, it won't devalue. I think we've seen record purchases of gold by the central banks in the last 2 years. And I think they're probably, we don't have the numbers yet, it's too early in the year, but I think they're probably accelerating that this year. And we're not talking about the European central banks, we're talking more the central banks which, let's say, are not the super friends of the United States. One central bank which is rumoured to have a lot of gold, but says they don't have much, it's only about 5% of the 6% of the reserves, is China. I think all central banks know that if there's some sort of new system forced on us by a failure of the dollar, panic in the dollar, then those who've got the most gold will have the loudest voice at any new system which gets developed. So I think nations are trying to build up their gold holdings, and that's partly a hedge against having all their assets in a currency which is showing, well, where the government is so far showing no signs of reining in the debt. I mean, everyone can see the projections from the Congressional Budget Office, which is part of the US government effectively, in which they forecast that the debt to GDP ratio will continue to rise. That means the debt is rising faster than the economy. To put that in a family context, it's a bit like your credit card debt getting bigger and bigger at a much faster rate than your salary is growing. In other words, your ability to service it is declining. And that's what's going on with the United States, according to the official forecasts. And there are a number of things happening which could make that worse than forecast. I don't think so. I think gold always had a place in portfolios, although for many, many decades, a couple of decades, it was almost zero. But I think it's coming back. I've seen a number of banks write to me and say, we're now moving gold into our preferred asset class, or we think the gold price will be higher. I see forecasts sort of moving towards the $4,000 mark. They're usually quite cautious, usually at any point in time forecasting $100 or $200 above the current price. But there's a few out there who are looking at $4,000 this year as a possibility. Of course, if the gold price does rise, they'll raise their forecast. But the important point is they are now writing about it when they weren't 2 years ago, a year ago. And they're writing about it because they want to encourage their clients to have some gold. And we're talking about exposure of 1 to 5%, as opposed to having 0% gold. I mean, I can think of one very large bank here in Switzerland where if I spoke to the wealth managers who work there, the investment managers, and you said the word gold, they said, you should have 0 in gold. Why should you have 0? Well, pays no interest, it's going nowhere, it's a pet rock. Well, they're changing their tune, and that's officially changing the tune. Now you should have some. And why should you have one? Well, the reason they say is it's an alternative to the fixed income portfolio, or fixed income part of the portfolio, because it's likely to outperform the government bonds, for example, because government bonds are going to face a crisis down the line because the need to borrow is growing faster and faster, and salaries and incomes is not growing fast enough to create that. So we're going to have less people being expected to buy more bonds, and that means the price has to go down.
Demand for silver is expected to continue rising, with projections suggesting up to a 170% increase by 2030, largely driven by industrial uses like solar panels, electric vehicles, and electronics. If investor interest also rises amid economic uncertainty, the silver price may skyrocket. As confidence in fiat currencies erodes, are you prepared for the potential rise in silver price that Clive Thompson warns could happen without warning? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.